In 2018, the Federal Reserve continued raising interest rates and reducing balance sheets, and the European Central Bank discontinued quantitative easing. What do we expect looking at our monetary outlook on a global basis for 2019?
I personally predict that both of these central banks will continue to be out of their mind. I learned as a kid that they always are, they always will be, and yet society pays them huge respect for someone that's basically crazy. William McChesney Martin was the longest running head of the US Fed ever, and he had this line that when you became head of the Fed, you took a little pill and it made you forget everything you ever knew, and it lasted just as long as you're head of the Fed. The point being that central banks are almost always acting under the wrong influences and thinking about things wrong, and people shouldn't expect much different. But unless the Fed or the ECB or Bank of England can do things, Bank of Japan can do things, unless they do something really extreme, their stupidity is pretty normal. Expect stupidity. Expect them to do stuff that isn't right, but don't overemphasize it the way most people do. Most people think they have more impact than they really have.
And don't react too hastily to some of those developments, because despite what central banks may or may not do, we want to pay attention to how that translates into money supply growth. And when you look at money supply growth, because on a global basis, it's growing just fine, right? Not accelerating too significantly, which would cause inflationary concerns, not falling over, which would imply, credit's not getting its way to the broader economy. So, despite some of the ill-advised policies by central banks globally, the money supply growth is growing at a just decent rate.
And I just want to reiterate a point that we've made for a long time, but still no one seems to get, is that these extreme monetary policies like quantitative easing and zero or negative interest rates around the world, they're bad, not good. They don't do anything to stimulate the economy. They don't do anything to raise money supply growth. They haven't driven inflation. When you look at this economic cycle and you featured all these extreme monetary policies, and yet we've had generally weaker economic growth in past cycles, certainly a lot weaker money supply growth. We've had very tame inflation. And so you take these policies that everybody has viewed as stimulative, and when you see that they're actually depressive and they actually are a bad thing for the economy, not a good thing, you can see how the emergence from them could be a positive. And why that's powerful for stocks is you take something that people fear and they think, boy, once we're done with quantitative easing, whether it's in Europe or the US and Japan, once that goes away, what's going to support the economy? What's going to support the market? That makes people fearful about the end. But when they see that the emergence from that is actually a good thing, that takes a negative view and turns it into a positive view. And you don't need to look past any further than just the recent history of the US, the UK ending their quantitative easing programs and seeing that things are pretty darn good afterwards, to see how now Europe is doing that. Maybe at some point Japan will as well. By and large, monetary policy is getting better, not worse. And yet it's a fear of things getting worse that's baked into the market. But when they realize it's actually better, that should be a powerful force for stock prices.
And for views on current events in the world of investing, visit marketminder.com. Updated daily, it offers on-demand access to Fisher Investments' most current thoughts on capital markets and the global economy, as well as our sometimes irreverent commentary. We hope you will enjoy it.